Hi everyone, Shuzafat Bless here from Tradable Online Services, and today I'll be taking you on the second part of the moving average video called the moving average trading strategy. So moving on to the risk warning, trading leverage products such as forex derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. So please pause this video and ensure you fully understand what you are doing before proceeding. Alright, and so let's get to it. Okay, so first of all, what's a strategy? All right, a strategy is simply any form of set of rules, I would say, all right, that help you to make guide your entry in the forex market. Why do I say guide your entry? All right, and why do I also mention a set of rules? All right, as you can see here, we have a scenario of someone buying here at this particular price level, and going away with a profit of 74 pips. All right, and the other scenario of someone taking a sell at this particular price level and going away with a profit of 52 pips. Now the big question is, how can this happen all the time, or how can I make this happen all the time? And I can tell you, and I can assure you again, this is the big dream of every single trader, to be consistently profitable on the market. All right, no matter the time, no matter the season. All right, so that's why there is need for a strategy. You need an accurate, of course, set of entry and exit rules that help you or guide your entries to the forex market. And what do I mean entries? That's opening a buy or sell position. All right, so let's move on. So a few things to take note here. Now we're going to talk about difference between a simple and exponential moving averages. Then we'll speak about the entry rules and the setups and so forth. Then we have the trading time frames for this strategy, which is the 15 minutes. All right, primarily. Okay, so I'm not going to be talking about a lot of basics here because we discussed that in the first video, which was introduction into moving averages. All right, and if you don't watch that video, please do well to go back to it, because there are a lot of things we will not be referring to here, like how to install an exponential moving average, a simple moving average, and the basics about moving average we will not be discussing here. So do well to watch that video before continuing. All right, so here we have the 50 exponential moving average, which is the EMA, and then we have the 200 simple moving average, which is the SMA. All right, so we have a fair comparison of two of them here. But as you can notice here, we have the 50 moving average in blue and the 200 moving average in red. Okay, so this is the major difference between a simple and exponential moving average, is that the exponential moving average tends to react quicker to a price change. You could see, with this long bearish momentum, you can see the quick quick reaction of the exponential moving average, whereas the simple average, just going along a nice curve all the way. All right, so that's the difference between simple and moving exponential moving averages. All right, and you have a fair comparison of them here. Like I mentioned earlier, you have both of them on the same period, which is the 50. All right, remember we spoke about periods in the first video. All right, periods of moving averages in their installation and so forth. So we have the 50 EMA here and the 50 XMA here on the same price setting. That this particular instance in the particular quote or currency pairs time, you have these charts here. So we have the same charts, all right, for both of them with the same period, but different type of moving averages. We have the exponential here and the simple here, so there's no magic. All right, so you could see the reaction of the exponential moving average. Can you see with this sharp bearish momentum? You could see the sharp reaction of the exponential moving average with this drop here along the trend. But let's come to the simple moving average. You have it's just running a nice curve all the way. With the sharp, you can see the very long bearish momentum that came down here. But you see the simple moving average doesn't just react like that. It just goes along with a nice line all the way. So you could see a fair difference between these two. All right, so let's move on. So here we get to the strategy. I'm going to show you guys a few examples before we actually get to the chart and get to see it for ourselves. All right, so here we speak about the rules. For example, we have the bounce strategy. All right, that's the strategy of today. Sorry, I didn't mention that earlier. Is a bounce strategy on moving averages. All right, so we have our entry rules here, which is the sticky note on your Windows, and I think on the iOS you should have something like that as well, that you can have, type a few notes on and then split your screen with your MT4. I use this because it really helps me to just ensure that I'm 100% on track with my entry and exit rules all the time, and while making entries on the market. So let's move on. All right, so we have the chart here and our entry rules here. All right, so the first rule, all right, for the bounce strategy is that you confirm the trend on the higher time frame and the lower time frame. To clarify this out here, we have the higher time frame, which we refer to in the bounce strategy as the H1 time frame. So whenever we refer to a higher time frame, it refers to the H1 time frame. Whenever we refer to a lower time frame, which is the actual entry time frame, that's the the time frame you look at when you're making the entry, all right, is the 15 minutes time frame. So we have the 1 hour, which is a higher time frame, and the lower time frame, which is 15 minutes. All right, so second rule says retest on the 18 or 50 EMA at it once. You have third rule says support or resistance point must coincide with the moving average. All right, and the fourth, make an order at the second reversal candle or directly on the exponential moving average, which is the 50 moving average. Then stop loss 10 pips away and TP 30 pips away. Trail to recent swing highs or swing lows, whatever you like to set your TP as. That is that for it. All right, and I have my key personal rules here. No big losses. All right, so I stick with my risk to reward ratio. No adding to a losing trade, very important. Once I have 2 consecutive losses in a day, I'm out of the market. I could stay and observe the charts and learn more, but no more entries, all right, for that day. Okay, so those are just a few personal rules. So let's get on here with the first example. All right, we have the GBP, the JPY. So the first rule says confirm on the higher time frame and lower time frame the trend. So we can see here we have a consolidating market. All right, so this is not reliable. All right, and like we said in the last video, when you have the three moving averages, which the first is the 200 moving average in red, 200 simple moving average, the 50 exponential moving average, and the 18 exponential moving average. All right, we spoke about this and their installations in the first video, so please, if you're still lost about that, do well to refer to that video. Okay, so we have the 200 moving simple moving average above the 50 moving average, above the 18. So this clarifies that this is a clear downtrend. All right, remember how we spoke about the very first thing you identify when you see a moving average is the trend. All right, so that's simple as that. So I gave this example specifically so you understand that when there is a consolidation on, despite the fact that you might have the moving averages aligned in a sequence of showing that okay, this is a downtrend, it's still not very reliable to trade this strategy. All right, very important. Now the thing here is that you can see this is a consolidation zone. It's not good for us. We don't want that. We want a clear downtrend. And guess what? Price broke out, came to retest at the 200 moving simple moving average. All right, then broke out, and then we had this nice downtrend. So we call it a clear downtrend. We do not want to have moving averages. Sorry about my battery going low. Let me quickly plug that. All right, so that's awesome. That's done. We do not want to have a scenario of moving averages, bundled up like this. That's not good for us. So we want them to be clear out. So you see the 200 clearly, the 50 clearly, and the 18 clearly. All right. So moving on, we have the second rule, which says a retest on the 18 or 50 EMA at least once. So you confirm the trend on the higher time frame, which is a downtrend. So we go to this lower time frame now, which is the 15 minutes. All right, so here also we are seeing a clear downtrend. All right, as you could see here, I marked out the chart in green, so that's the same continuation here. So don't mind the green background color. Okay, so you have the a clear downtrend here as well. You can see that. You can see that starting from here. All right, the three moving averages clearly. in a bearish sequence. And the second rule says retest on 18 or 15 EMA at least once. So we have the first retest here on the 50 exponential moving average. As you can see there, the price retest couldn't break it. Then you have a bearish boom, came down, and then this was the second retest. So this is our point of entry. This is where we actually really consider to make an entry. So let's go back to the rules. Support or resistance must coincide with the moving average. So we must have a support or resistance level that actually goes in line with this particular moving average at this particular price point. So this is the first test on the 50 moving average. On the second test, we're hoping to see a support or resistance level that coincides with this second retest point. So the price comes, test at this point. You want to ensure that there is a support or resistance level that coincides with it. Okay, super important. All right, and this you can see here, price trying to break this particular level various times with the strong bullish momentum here, pushing it all the way. Then finally broke it, then came for a retest. So that really that clears out our third rule, which says it must coincide with the support or resistance. So make an order at the second reversal candle or on EMA. So after clarifying those 3 points, on my fourth rule, it says I can make an entry at the second reversal candle. Now, what's a second reversal candle? Let me zoom in a bit so you see this here. A second reversal candle here is this particular candle. So let me get okay. So you see here we have the all right. So we have the first candle here. You see that? Now this is the second candle here. Can you see that? Okay, this is second bearish candle, so that's the second reversal candle. All right, we're expecting a bearish momentum after this bullish retracement. So of course the reversal candle will be a red candle. All right, so we have a second reversal candle with this bearish candle, and that is our entry point. All right, super important, guys. Let me clean that up. All right, so we have that to be there. Okay, so that's super important, right, to take note of. So we have this our second reversal candle. So we make our entry there and identify that with this colored rectangle here, and then this could be your stop loss. Of course, now your stop loss is behind the dynamic support and resistance, which is a moving average, and also this resistance price resistance point here. So that's a double secure double protection on your stop loss. All right, then you can have your take profits according to your risk to reward ratio. I gave an example here, which is 10 pips, all right, to 30 pips. All right, super important. But some people like to trail according to recent swing highs and so forth. So in your case, all right, if you like to trail according to recent swing highs and swing lows, this was a previous swing low here. All right, so you could decide to take this as your take profit. You're out at this particular point on the market, boom, that's it for you, and that's it for your profits. All right, so we're going to have more examples on this. All right, as you could see here, you have another scenario here. All right, we've confirmed the trend on the higher time frame. Remember here, the major time frame of your trading is the 15 minutes. All right, if you are confirming the trend, which is basically the only thing you do outside the 15 minutes time frame, is going to be on the H1. All right, super important. Pardon my writing. All right, is on the H1. That's where you do the that's where you confirm your that's where you confirm your sorry about this. That's where you confirm. I wanted to clean this up. Okay, so that's where you confirm your trend, all right, which is on the H1. So we have here, so we have here our sorry, let me get this done. Okay, so we have a nice bearish momentum here. You could see moving averages. This is the first one, second, and the third. All right, all in a nice sequence. Price came down and went back for a retest. All right, this, you look at this retest very well, it coincides. This is a very this is a good support zone turned into resistance. You can see price tested it here. All right, also couldn't break off here. could see another retest here and so forth. All right, all the way around here. So we have that's checked out as our third rule. And then the last one, which says you make an entry on the second reversal candle. So this is our second reversal candle here. Remember I said the second bearish momentum, bearish candle, right, in terms of a downtrend, right? And if it's an uptrend, of course, it will be a bullish candle. So we have that here. But some people like to be very aggressive while on the market, all right? So that's why we said, and get back to that rule. So you see that's why we said, make an order at the second reversal candle or on EMA, all right? And what we mean by or EMA, which is of course the exponential moving average, is that you can just set a pending order here, all right? You could just set a pending order at the moving average with your stop loss, of course, above, which you can see here. This second line is our stop loss. You see that this is our entry point. This is our entry horizontal line indicator, and then this is our take profit indicator as well. All right, pardon my drawings, guys. All right, so some people just like to be very aggressive and they could make an entry here. All right, but there's a problem with that. All right, it works, of course. Maybe you don't have the time, you have a few things to do, and then you might not be privileged to be on the market that long. You could set a pending order, but there is a disadvantage. Disadvantage is this: the reason why we wait for a second reversal candle is the fact that that indicates that we have the retracement really finished. All right, and you notice that once we have the second reversal candle, we get in, most likely we have the very, very high chance of closing that trade in profits. All right, but when you have a pending order set here, what if there's a deep retracement on at that particular that particular point, all right, in the market? That simply just activates your order and then wipes out your trade in a loss. All right, so that's why we mostly recommend that you take an entry on the second reversal candle. All right, and some people like to trail according to recent highs and so forth. You could do that on the H1 or simply on the 15 minutes. Some people could have taken out here, taking profits here and so forth. Some people, you have your risk to reward ratio, like I gave an example here, 1 to 3, all right, which is risking 10 pips to get 30 pips. So this is the last example we have here. There is going to be, or you would most likely come across this scenario where you had a consolidation kind of, all right, and then the price now breaks out of that, and then you have a nice trend. So what you do is this: you have first check your normal rules. All right, it's very important. You have the first one, all right, this is a check for us, this is a check, this is a check. All right, so we have these three done. That's indicates that is a nice downtrend. Remember, we confirmed on our H1, all right, and that's super important. So we have the price come and just consolidate here. Remember, we've had a first retest on our exponential moving average, but here it doubled with this simple moving average, all right, and we're expecting a second retest. Then this now happens. So do not get confused at this point. Simply wait for the breakout. And what you can do to help yourself in this situation is to ensure that you have a rectangle drawn out. All right, so once you draw out a rectangle at this point, it will help you know the ranging price zone. So you can see here is within this point to this point. Pardon my drawing, guys, once again. So we have our entry that would simply be made at the retest, all right, or simply you could directly make an entry at the breakout, all right, and that's basically what I do. All right, so you could make an entry at the breakout of the consolidation. Let me clean this up, sorry. Okay, so my entry here is on the second reversal candle, of course, like we always say. All right, but that is after the breakout. So you can see this is the candle that broke out of the consolidation, but next after it came a bullish candle, as you see there. But after that we had another bearish candle. All right, so I'm waiting to have the first bearish candle and then another one following it. So this is my entry candle, right, the second bearish candle. So that's where I make my entry. Then I can have my stop loss directly within the consolidation zone. You might not possibly place your stop loss here, all right, because of the distance, but that might be too far for your risk to reward ratio, or what you can afford to lose in that particular trade. So what we simply recommend is that you have your stop loss set within the consolidation zone. Of course, it already is the consolidation zone, so if there's going to be a retest, it will only be at the support of the consolidation zone now turn into resistance. So that's exactly what you have for that. Then you could trail your trend all the way. All right, so let's get to the chart, have a few examples of this. So we have the Euro USD in this case, all right, that we'll be looking at. You have that. So I circled, I kind of used these lines to ensure that we have, a niche. What am I saying? So we have a particular price area that we're going to use for this example. All right, they are all over the chart, all over. As you could see that this is just on the H1. You could see a clear downtrend. All right, you could see that they are all over. Well, I'm just using this one. All right, so you see, and with a few points to make on that. So we have the first thing on our rule says confirm the trend on a higher time frame. So what do we have here? We have an uptrend, all right, but this uptrend really is confirmed from here, but that's not so reliable to us. Like we said, the 3 moving averages must be in sequence. So on an upward sequence, we have the 200, 50, and 18. All right, so these 3 must actually cross. These 2 must be above this, right, for us to confirm that it's an uptrend. So at this particular point in time, we do not so rely. This is not a reliable uptrend at this particular point. Let me just draw that so you see that. All right, so this is not a reliable uptrend until both of them, they all crossed, and then we have this actually as a reliable uptrend, as you can see there. All right, sorry, that's not so perfect. Okay, so this is an awesome uptrend here because the 3 moving averages are in sequence as we see that to be. All right, so that's the first point. So now we'll move to our 15 minutes. Okay, so we have the I cut out the other parts, I think. Yeah, did I cut it out? Okay, yeah, we have that. Awesome. So we have the 15 minutes here that tells we must have a retest on the 18 EMA. All right, so you can see this first test was not on the 50 moving average. It was on the 200 moving average. So that's not our test. So where is the first retest we have on the 50 exponential moving average? It is here. All right, although it's a very deep retracement, we have that couldn't break off the 50 exponential, bounced off and then came for a second retest. So this is our point of interest. All right, this is where we want to do the thing, make our entry. So we have the support or resistance coinciding with this. So let's check that out. We have that here. So you could see, this was a previous resistance now turned into support. Can you see that? Let me zoom in a bit so you have a clearer view at this. All right, can you see that? Previous resistance now turned into support. Let me get that. See that? Okay. Or I could decide to just take it all the way down. All right, can you see that? Okay. So we have that. All right, previous resistance now turned into support. That's awesome for us. All right, and what do we do next? All right, so we have make an entry on the second reversal candle on EMA. So we have this as the first reversal candle. Can you see this was a retracement to the moving average? So that will be a bearish momentum. Then we're expecting a bullish, impulsive wave after that. So that is the first reversal candle here in green, and the second reversal candle also in green. Remember, all right. So that's super important. So our entry will be here. All right, our entry will simply be at this particular. What am I doing? Sorry about that. Let me use this. Okay, we'll have that here. Oops, sorry. Okay, we have that. Let's make this. Okay, let's just make this a green line. I think that will be easy to. Okay, so you have this green line here as our entry point. All right, our entry point somewhere around here. Okay, then you have your stop loss. All right, 10 pips. Can you see 10 pips somewhere around here? But that's too large. Or you could decide, okay, I'm just going to put it at 8 pips. That's awesome already. You have your SL at 8 pips. Let me just use this so you could be faster. You have 8 pips there, stop loss, and your take profits, 30 pips as we have it here, and that works awesome. Check this out. Check this out, guys. Check this out. All right, so that's over 50 pips. So 30 pips is around here. You've TP'd out and you're out of the market. Boom, that's the winning trade. All right, so that's it about that. That's just an example. Remember, you have another test here. All right, you could have made an entry here, but you see, no strategy is 100% reliable. All right, and that's exactly one of those things we speak about in strategy. So this strategy is not 100% reliable. There are times you have losses, and I have a set of rules for that. All right, and the first is that there are no big losses. All right, ensure I stick with my trading discipline, my leverage, risk management, risk to reward ratio, and so forth. All right, I do not use insignificant leverages. All right, and I ensure that I risk only 1% of my account per trade or per position open. All right, so no big losses. All right, no adding to a losing trade. All right, very important. There is this tendency to okay, someone might say, okay, well, let's find another scenario. We had a bearish momentum here. Okay, we had a bearish momentum here. So let's go on the 15 minutes. All right, so you can see the same bearish momentum all the way here. So someone might say, well, since we have a bearish momentum here, and let's say I had an entry here, okay, we had a breakout, coincides. So we have a second. So I had an entry here with my stop loss, of course, 10 pips. All right, here, for example. All right, that was the winning trade all the way here. And maybe you didn't set a take profit, which is which we do not recommend. All right, but someone might say, okay, well, I've been trading this trend from this point, and it seems to be going well all the way. So why don't I just make continuous bearish orders? Oh, I say very sorry. Why don't I continuously take more short positions and so forth and so forth? Well, that's not so advisable, all right, because we would not recommend that, because all right, you should have a progressive mindset. All right, we win 30 pips today per trade. When you have 3 trades in a day, you had 1 loss, all right, but you had 2 wins, all right, and that's awesome. Okay, very progressive along the way. You actually sustain your winning record over a long period of time, all right, and you do not leave your profits on the table until they are finally taken away or wiped away by the price. So that's super important. Always trade with a stop loss and a take profit. All right, of course, when you have the beginning of a trend happen, all right, some people, for example, they got in here, let's say they got in here, all right, and they've had 10 pips will be here, pretty tight there. Okay, so maybe they were still in the trade, and then the price was at this point about 57 pips profit. All right, there is that tendency, okay, let me just leave it so it goes a bit longer and so forth. But then you have this retracement, all right, so you do not know what will happen next. So it's best you trade according to your rules. Remember why we have a strategy to sustain our winning record. Let me go back to the first slide, so you just remember that. All right, remember why we have a strategy is because we can make this happen all the time. So we want to make this happen almost all the time. Right? Of course, there's no perfect strategy, but we want to make that happen all the time. Remember that. So that's super important, guys. Ensure you trade with a stop loss and moving and take profit. Super important as we proceed. All right, so rounding up here, I leave you with a quote, all right, which is practice makes perfect progress and not perfect. All right, the more you practice this, okay, over time, the more you practice this, the more you get used to it, the more you get to know a few things, notice a few things, all right, that actually might be key to your entries and so forth, and you gain mastery over a period of time. All right, there's sometimes you would say, okay, you could see, for example, okay, this shows up to be a very nice for example, this shows up to be a nice buy or that and so forth, but I know there will be a few things about it, so forth. You just get to have you grow your experience, all right, in the particular strategy that you trade, and that's the beauty of practice. All right, it makes a lot of progress. All right, there's no perfection, like I said. There are times you have losses and so forth. All right, and those just a part of that's just part of trading. All right, there's nothing that is so perfect, all right, and so forth. So these are one of those scenarios where you do not want to enter the market or open the position with the moving averages when there is a consolidation, all right, and you have the moving averages in this matchy pattern. All right, so that's not really good for us. Even also here, we want to have a clear sequence, all right, a clear sequence. This is not so clear. All right, we want to have a clear sequence. Those are not so clear. For example, you can see this is a very clear sequence of the 250 and 18 and so forth. So we do not want to have consolidations and so forth with our moving averages. All right, super important. As you practice, you get to have or make more progress. So Josephat Bless here, thank you for following us in this video. All right, hope you learned a lot. Do leave some comments in the comment section below and have a great day. Thank you.